But today, what we're going to talk about is, just an insurance refresher. When you need to take out, when you need to update your insurance policies, and also when you need to get one as well. So talking about different types of policies, what are the things you can factor in when you're looking to reviewing it? What are some tips and tricks you can do to update your policy without having to go through some of those questions as well that the insurance companies like to ask.
Awesome. Have we got a poll? Trent?
We do have a poll. If we can get that poll put up in the chat. I don't have the poll handy. Oh. Here we go. So we just want to know who currently has an insurance policy in place.
Mostly yes. 80% yes. 86% yes.
Awesome. So it looks like, most of our answers coming through are for yes, with the one nope. So in terms of the one nope, we'll start our conversation regarding what sort of insurance policies we're looking at, what we're going to talk about today, and the sort of things that you could use them for. For the yeses, we have a second poll. Can we get that one added in as well? We just want to know who has tried to change their policies, reviewed them, amend them before.
Ooh, some people have been through it already.
Awesome. For those that are saying yes to amending, if you want to put in the chat the reasons why you look to amend your policies, and if you have any comments about how you went with it, was it easy, was it hard? Any comments? We'll be happy to read them out and go through any sort of experiences you've had.
What about you, Trent? Have you amended your policies?
I did. I amended mine earlier this year, and I had my knee exclusion taken off my policy, which was really nice. I did leave it for a bit longer than I should have, but got away without having any health events, which is great.
Oh, that's good. Awesome. What was the prompt to update your policy?
I got a policy anniversary, and it was 3 years since I did it last, so I thought I'd better step up to the plate. So, it was worth it. Got it at the right time. What about you?
I've got my 3-year policy anniversary coming up in November, so I'll get like an easy upgrade then. And then I've just taken out a mortgage about a month ago, so going through the process of using that as a reason to increase my cover. But I've managed to hurt my back and my wrist in that time, so I'm expecting I'll probably get an exclusion on any extra increase, but that's okay.
Sounds fun. We'll go through it a bit more depth later. So let's start flicking through our slides. Any questions anyone does have, please put them in the chat section. If we don't get them straight away, we have a section at the end to go through any questions and answers. Awesome. So we have a disclaimer. So any information we go through today is just general in nature. It shouldn't be relied upon when assessing if your policy is right for you. Please make sure you read your own insurance policy, product disclosure statement for confirmation, or any other information we provide in this webinar. Main thing is get advice. If you don't know what you're looking for, it's always best to get advice on your specific situation.
Perfect. So there's a few things that we're going to go through today. First of all, as Trent mentioned, we'll have a look at the different types of personal insurance that are available and what they mean. We'll have a chat about when you should review your insurance, what life events might warrant updating your policies, and then we'll go through how to update your policy as well. And then Trent, for the other ones.
Yep. So we've got some case studies that we'll go through. So we've got a couple of different case studies about, when people have increased their policies or haven't increased their policies, how to get started in terms of getting advice from Skye or anyone else. We'll run through any questions and answers you have, and updating webinars that we have, and allow you to provide some feedback too. Awesome. So I always like to provide a quote at the start, and this one today is going to be: "Failing to prepare is preparing to fail," which is a Benjamin Franklin quote. I do have something on the next slide as well, which we have Walter White, which is a bit of a story. So I was shocked to find out that most people at Skye hadn't actually seen Breaking Bad. So if you haven't seen Breaking Bad, the whole premise of the TV show is Walter suffers from cancer really early on, and he has no money. He's about to pass away. So he starts making methamphetamines in America. Obviously, it's a fake story, but he becomes one of the biggest drug producers in America. So if Walter actually had insurances, this whole story wouldn't need to exist, and he would have been pretty boring. we want to be boring. We want to have our insurances intact just in case the worst happens or anything else in between. So that was the premise of having Walter on here.
Awesome. So we're going to have a look at the different types of personal insurances that are available. There's 4 and sometimes 5 different types. So the first one is life insurance, so also known as death cover. We've also got total and permanent disability cover, trauma insurance, income protection, and child insurance, which is the 5th option if someone has kids. So life insurance, first of all, this is the one that would pay out a lump sum of money if someone were to pass away or be diagnosed as terminally ill. So when people are looking at getting life insurance, often they're looking at replacing some of their income if they were to pass away, because, you know, if you've got a family, you've probably got financial goals in place. You want to make sure that your family can still achieve them. And another big thing is covering debt as well. So if you've got a mortgage, for example, the last thing you want is your family to be worrying about, you know, trying to fund a mortgage on a single income. So that can give them a bit of freedom there as well. So yeah, life cover, also known as death cover, that's a really important one to have.
Awesome. The next one we often use is our total and permanent disablement cover, often shortened to TPD. Some people will call it TPA and other sorts of things, but it is TPD. So how permanent disablement cover works, it will pay out a lump sum benefit amount if you're to be totally and permanently disabled and unable to work again. Depending on what your policy says, it could be to your own occupation, it could be any occupation, or it could be a home duties or an activities of daily living. So can you function and look after yourself? All depends on what policy you have, but the most common one is, can you work in any occupation? So things we're looking to do when someone becomes permanently disabled is looking at covering those initial medical costs that may pop up, any income replacement that income protection doesn't cover, or if you don't have any income protection at all, maybe covering a little bit more income on top of that again, and covering your debts that would be still there if you were to become permanently disabled.
Perfect. The next one is income protection insurance. So income protection pays you a monthly benefit if you are unable to work for an extended period of time. And that could be due to an illness or an injury or even a mental illness in some cases. And in terms of how much you can get from income protection, so generally you get insured for 70% of your income. So it doesn't cover 100% of your income, but it does cover a good chunk of that. And that can help you cover your ongoing living expenses in that time that you're not able to work. And every income protection policy comes with a waiting period. So this is how long you'd need to be off work before you can start to claim. One common misconception is that you'd get back paid for that waiting period. That's sadly not the case. You're not covered during that first waiting period. So let's say you've got a 30-day waiting period. You would be eligible to claim after you've been off work for 30 days. So that's roughly how the waiting periods work. And then every income protection also has a benefit period. So that's how long you could be on claim for. So that might be 2 years, that might be 5 years, or you can even get policies that would pay you that income protection until you're 65 years old, if you could never work again, theoretically. So you can get short-term, long-term income protection, and essentially replacing some of your income, covering bills, covering living expenses as well.
Awesome. And a trauma cover. So trauma cover is the last of the personal insurances for adults that we look at. So it pays out a lump sum upon diagnosis of serious illness. So the most common claims that we see are cancers, heart attacks, and strokes. So unlike permanent disablement, where you've never got to be able to work again, and income protection being unable to work, trauma is paid out on the diagnosis of that illness. So if you have cancers, heart attacks, strokes, or any other illnesses that are listed, which is usually about 40 of, you get paid out straight away. What we use it for is we look to use it for medical expenses, making sure that you're not out of pocket if you do suffer a major illness, and any income replacement that your income protection doesn't cover, or again, if you don't have income protection, maybe it's covering a little bit more. You may cover some of your partner's income, some extra expenses so that maybe they can stay home, look after you, look after your children in possibly one of the most stressful times in your life, making your life a little bit easier in terms of the finance side of it.
Awesome. And the last one is child insurance. So if you have kids, this is something that you might consider. So it's similar to trauma insurance in the sense that it generally pays out for serious illnesses. This one also pays out for death as well. So it's the least comfortable one to think about. But again, things like cancers, loss of hearing, loss of eyesight, neurological conditions, that's when you could look to claim on a child trauma policy. So when we think about why you might need that, it could be that if your kid gets seriously ill, you have the option to kind of just drop everything and tend to whatever it is that they need. So that might involve covering medical expenses. Of course, we've got a great public health system. You might even have private health, but for anything out of pocket, or if you needed to seek specialist treatment or go interstate or overseas, again, you've got cash to go towards that. It could also be used for yourself to take time off work to care for your child, or just any other extra expenses. So if anyone's had someone that they love in hospital for an extended period of time, hospital parking alone is very expensive. You might need to stay away from home for an extended period. So yeah, having a child trauma payout just gives you that flexibility to kind of drop everything and be there for your child.
It also sort of allows, as well as the adult trauma as well, sort of allows for going, well, if the best treatment is overseas, let's fly over there and get the best treatment as well, rather than relying on that home system where we might not have the best doctors in every different illness. We can go across the globe and find the best doctors that we need to. So our next slide here is our types of cover, or where we can actually access these types of cover from. So there's usually 3 angles that you can get insurances from. So the first one is the group cover. So group cover is what you'll typically get through your super fund and employer. Usually there are some form of limitations with this where you don't get to choose some features and benefits. They can take the cover away from whenever they want. But often is the case that either through your employer, if they have a system, or your super fund, they'll give you a level of cover without having to go through any medicals questions or having to apply for it, which can be really beneficial for some people. So that's one of the options. Another of the options is direct cover. So this cover is offered directly from the insurance companies or under other intermediaries, if I can get that word out. Those sort of things are, say, the Today Show, you'll see Koshi and the Cash Cow selling insurances, general insurance brokers, or things like looking up online. Usually these covers may have some features and benefits that aren't as good or what we're looking for in some policies. Again, they could potentially be cancelled without you knowing, and they often offer taking out the cover without doing any medicals or any medical questioning, which is usually done at the end of the policies. So, or when you try to claim, which can often be a little bit harder, or you might pay for a policy for 10, 15 years and they say, actually, that was a pre-existing health condition that we weren't going to cover you for. So you don't actually have that benefit when you need it the most. Our last one is our retail cover, which is what we will typically use and like to recommend. So retail cover is through a financial advisor. They usually have the features and benefits we want. They have a feature called, or a definition called, guaranteed renewable, which means if you're paying for your insurance premiums, your insurance policy will stay the same and it will stay in force, where they can't cancel it whenever they want. That's the main one we're looking for. There's other features and benefits that you're able to access throughout the retail cover as well, that might fit your needs. But yeah, it's all coming down to what your situation is. As one person's features and benefits that are necessary may not be necessary for the next person, depending on your wants and needs.
Perfect. So we'll have a chat about how often you should review your insurance cover. It's a question we often get. Should I review it every year, every 2 years, every 5 years? So we'll touch on some of the reasons you might want to review your cover. So first of all, check your policy every renewal. So each year you're going to get usually about 6 weeks in advance a letter letting you know what your new levels of cover are. So they may actually increase your insurance each year. They can't decrease it on you, and that'll outline what your premiums are as well. Second point here, another good question we get: should we move around every few years like car insurance? So definitely best practice with your car insurance, your health insurance, review it every year, see what's on the market, are there cheaper options available? It's not so much something that we see people doing with these personal insurances. If you've been through the process of getting personal insurance, it is quite time consuming, and it does rely heavily on things like your medical history, your occupation, and things like that. So it may be that by the time you want to review your policy, maybe you've had a few extra health issues pop up, or you're in a different situation in terms of work, and potentially moving might actually put you in a worse position in terms of your insurance. So it's not generally something that you'd look to redo every year.
Awesome. The third one is reviewing exclusions when they are reviewable. So this is something I did earlier this year. So when I first took out my insurance policies, I was coming off an ACL injury from playing football. Clearly wasn't fit enough at the time playing. So had surgery. Then I had taken out my insurances and then ended up with a knee exclusion. So that was about 5 years ago. And some exclusions they'll offer a reviewable period. If you don't have any symptoms or treatment, and they can see that your injury or illness is getting better, or is better, they can often look at having that exclusion removed from the policy. So for myself at this point in time, if I still play football stupidly, if I was to go and hurt my knee and be off work because of it, my income protection would actually pay me out now, because it's been that period of time that I was able to take it off. How it works though is you have to go and apply for it to take it off. So they wouldn't have gone and said 5 years ago, we will take this exclusion off in 5 years, unless you come and see us. So basically I had to apply for it and say, hey, my health has got better. I don't have any injuries or ongoing symptoms for this injury, so can you take it off? And they go ahead and take it off for me. If I hadn't have gone back to them, it would have remained on there, even if I had gone that period of time without having that injury. Number 4, we suggest adjusting policies when major changes in your overall situation mean your insurance needs change as well. So as your needs change over your lifetime, we expect, or we would like you to update your insurances, whether that's increase, decrease, or change them altogether when those major events happen. So what are those major events?
So there's a few different major events. Really, it could be anything, but the main things that we see are, first of all, changes in your debt level. So that could be that you've bought your first home, maybe you've upgraded and you've got a bigger place, you have a bigger mortgage, or perhaps you've downsized. So that can definitely impact how much, life and total and permanent disability insurance you might need, for example. So that's a really common one that we see. Trent, do you want to take the second one?
Yeah, so changing your family structure. So if you were to have children, become divorced, those sort of things, those will change the family structure and who relies on you for money, in terms of if you pass away, who's relying on you. If your parents pass away and you're getting an inheritance, that could change your family structure as well, and your overall need for insurances. If you have a large inheritance coming in, hey, maybe you don't need as much life and TPD because we've now reduced your debt. We've got that funding there. Those are the sort of things we're looking at with that family structure.
Yeah, another big one is occupation changes and income changes. So, for example, if someone took out their insurance when they were working underground in the mines, maybe they're paying quite a lot for that insurance, and then they've moved on and they've gone to an office job, for example, where they're sat at a desk all day, like me and Trent, and are very little risk of doing anything, then potentially we could look at updating the policies at that point. It might mean that their premiums come down. Also, income is a massive one as well. If you've had a significant change to your income, perhaps your income protection is no longer sufficient, and we might want to look at increasing that. So even decreasing income as well is a really good prompt to review your insurance.
Awesome. And this one sort of doubles up with the changes in family structure, but starting a family is a very common one we see. Having children, what does that mean? Okay, do we increase your life cover? Are we looking at child trauma cover when they're getting to the right ages that the cover is going to be accepted? What does that look like? And each people will have what we think is recommended and what our general gist is, but other people will come and say, well, if I become a single parent, I want to live X amount of life. So we can provide that. Other people go, I just want to cover the bare minimum, and we can find that happy medium within that.
Yeah, and the last one is kind of what Trent mentioned before, like changes in health situation. If your health is improved, maybe we can look at removing exclusions or kind of getting a bit of a reassessment on your health situation. So that might be a really good opportunity to kind of unrelated. If your health has worsened, potentially there's a claim there. So again, that's another time to reach out to your advisor for a bit of a review and see if maybe there's anything there we can look at claiming on.
Awesome. So how to change your personal insurance policies. So the first couple of things is decrease. Well, the first thing you can do is decrease your cover. Decreasing is typically very easy. and you can request that directly from the insurer or through your advisor if you have one. The advisor could possibly look at different options because sometimes decreasing cover isn't actually worth it. If you decrease cover, you might be paying only a little bit less for a lot less cover. So providing you those options throughout. Why decreasing cover is a lot easier than increasing is you become less of a risk to the insurance company. Instead of saying I have $1 million of life and TPD, you reduce that to $500,000. Yes, the insurance company is making less money if you're not claiming on it, but they're saying, well, you're less of a risk to the insurance company in terms of what they have to pay out. So we're happy to reduce that without asking you too many questions regarding your health, what you're doing for work, all that sort of stuff, because it's nice and easy. You guys are, sorry.
Yeah, easy. On the flip side, increasing cover, that requires a little bit more effort. So kind of complete opposite of what Trent said. When you increase cover, you're actually increasing risk to the insurance company in some way because they're on the hook for more money if you were to make a claim. So they want to get an understanding of what your health situation looks like at that point. So let's say, for example, you've got $500,000 of life insurance and you want to increase that to $1 million. That extra $500,000 would be treated as a new insurance application. So you'd be looking at going through medical underwriting, occupational underwriting, and there are a few forms involved in doing that. So that's something that, if you've got an advisor, they can help you out with that. There's also the option, if you've got a retail policy that you have taken out through an advisor, often there's something called future increase option, which means if you've had a certain life event, and we'll go through this in a bit more in a moment, if you've had a certain life event, you might actually be able to increase your cover to a certain degree without having to go through any of that medical underwriting. So that's a really good one as well, and one that we try to use where possible.
Awesome. So a bit more on that future increase options. So it's only typically offered on specific policies, mainly retail policies, and some insurers will offer on different ones. And it's all sort of different per insurer and each policy, individual policies. So I know there's at least a couple of insurers that will look at offering it on income protection, where a couple of other insurers won't offer it at all on income protection. We'll be able to go through that matrix in a minute. There are limited criteria to the amount of increase and when you can action it. You can't just go, well, I want to go from $500,000 to $5 million because of X event happened. They'll often put a percentage increase on it and then a dollar figure on top of that as well. And those specified events are different for each lump sum, life, TPD, and trauma versus income protection again. So yeah, some will have it for all of them, others will have it for some, and there's all sorts of different criteria.
Perfect. So 5 examples of life events that might prompt using that future increase option. Purchasing a home. So timing is key with all of these. It can't be that you purchased a home 2 years ago and now you finally decided to increase your cover. You won't be able to do that without underwriting because there's usually a time limit, like it needs to be done within 3 months of taking out the mortgage, for example. So yeah, purchasing a home, most insurers will allow you to increase your cover to a degree without underwriting for that one. Getting married and getting divorced, that can require a change in your financial situation. So that's often one that you can use. Having kids and having a major income increase. So for example, if you've had an increase in pay of, let's say 15%, some insurers will allow you to increase your income protection without needing to go through that medical underwriting process.
Awesome. So we've got a bit of a table here and we won't go through every line because it's relatively finicky, but this is a few of the events for lump sums. And each column here is a different insurer. So we've just taken the insurer off the top of this. But as you can see, most of the insurers or all of the insurers will have event as marriage as one that you're able to increase your cover without going through underwriting. One that's not is dependent children starting primary school. So some people will see that as going, well, I need to have more insurances because I'm now working more. My children are at school so I can go to work. So I'm going to increase my insurance cover. Some will allow you to do that without underwriting. Others you'll have to go through full underwriting. Another one is your spouse dies. There's a couple of insurance companies that they don't care, but they don't care about increasing your cover at that point in time without going through underwriting.
Perfect. And for income protection, so income increasing, what is that about? Half of the insurers will allow you to do that annually. Some might only allow you to do that every 3 years. Income protection, it's more based on income increases, things like giving birth or getting married. generally doesn't allow you to increase the income protection. One of the insurers seem to be able to do that, so that's good. There are restrictions there. So if you've got a significant number of exclusions or loadings, there might be some insurers that don't allow you to do that. They might actually require you to still go through the underwriting just in case your situation has changed drastically. And there's also the age of which you're eligible to use these, and different requirements in terms of how you can actually make those increases as well, depending on the insurer.
Awesome. And Taryn, I think I might have your question on this slide here. So Taryn's question was, is there a general limit on the time frame after birth that you can use these options? So a lot of the eligibility windows is 30 days from the event or policy anniversary after the event. So you've got that first 30 days, usually before and after the event. For some insurers, it will change, but then also when the policy anniversary comes around. So let's say you would have a child tomorrow, but your policy anniversary date wasn't to December. You would have 30 days today for the next 30 days, but you'd also have 30 days around December as well to action this if you didn't want to go through underwriting. So everything we've gone through so far regarding our future insurability stuff, if your health hasn't changed, we're not expecting any other exclusions or loadings on your policy. We can go through regular applications and have no issues at all. This is sort of just a shortcut to cut out any extra loadings or exclusions you might expect, or having to go through the full forms and do the tele interview and go through any medicals that you may have to do as well. A few other things on here. So we're looking at lump sum increases of around lesser of 25% of what your original benefit amount is, or $200,000 is your typical ones. And then income protection, looking at about 15% of current monthly benefit, or a maximum cap of 70% of what you're earning. So there's a few different parameters in there. So it's not a be all and end all, but it is an option to help limit getting those extra exclusions and loadings. And is this something that you will go with, Azaria, when you look to increase your policies?
Yeah, that's right. So I'm increasing my life and TPD at the moment after getting the mortgage, and that's going through without underwriting. So it doesn't completely cover the new mortgage. As you say, it's only usually 15, 25%, depending on the insurer, but it does mean that that's, less underwriting that need to go through for that amount. So that's handy.
Awesome. I'll re-answer your question, or your second question here, Taryn. So if you expect new exclusions, none of this kind of applies. So it's a bit backwards there. So Taryn's question was, so if you expect new exclusions, none of this kind of applies anyway. So basically what we would do is, if you were expecting new exclusions, so with Azaria, she hasn't currently got the back or the risk exclusion on her policy, she would go through, and she's going to go through these options to increase her policy so that her new policy or the new amounts on the policy don't have any exclusions on it. Yeah. If it was the other way around and Azaria already had these exclusions on the policy, or the health events hadn't happened, I dare say you'd probably go through underwriting and go through with the full amount of cover that you're looking to get, so that it's going to end up with the same result. You just have to put in a little bit extra work to go through that application.
Yeah.
Awesome. I did have another point. So the other point would be there's an often question we get is, if you are to increase your policies, what happens to your policy that's been in force? So if you've got $500,000 of life and TPD, and I'm making this up for Azaria's case, and she wants to increase that to $1 million, they won't change the $500,000 that she already has. So they won't backdate that exclusion or loading that we're expecting with back on the risk exclusion. They would only update that for the new $500,000. So what her policy would be is $500,000 at standard rates, and then another $500,000 with a back and a risk exclusion as well on top of that.
Yeah.
Awesome.
Perfect. So we've got some case studies of real examples from our clients where they've, been through this process or tried to go through this process. Before we do that, Lara asked a great question. Will a recording of this webinar be available? I missed the first 10 minutes. Yeah, we will send through a recording. Is that either tonight or tomorrow, Trent, of the whole?
I think it usually goes out tomorrow.
Perfect. Yeah, keep an eye out in your emails for that one.
Yeah, we usually only get about 30% of the people who register, because I know for one that, 7 o'clock when I'm told to be here on time, I'm only here because I have to present it. I'd much rather watch this at a time that better suits me, maybe on the couch on a weekend.
Yeah, perfect. So we've got 2 case studies. Trent's going to take this first one.
Awesome. So this is a case study of a client who actually didn't increase their cover. So this case was a female, age 32, no debts, white-collar worker, which doesn't really affect the case that much. But in 2021, she got advice from us, and we recommended taking out 70% of income protection, or income protection for 70% of $100,000, which her income was, amongst other things regarding her permanent disablement, life, and trauma cover. So that income protection policy was taken out and accepted. 2023 roll around, and she had increased her income to $140,000 at that point through a couple of promotions. So she booked in a call with Skye, went through her options. Hey, do you want to increase your policies, decrease them? What are your options? What are you looking at currently? And she decided that she didn't want to increase it at that point in time. January 2024 came around, and she made a claim for her income protection. And because she hadn't increased it to 140,000 or 70% of 140,000, she's only currently receiving $70,000 of the $100,000. So her income has gone from after tax 140 to after tax or $70,000, then after tax after that. So her income has actually dropped quite significantly than what it has been over, say, the last 12 months because she hadn't maintained her policies. Yes, she'd done the phone call, but she didn't go ahead with actually increasing. And at that time in 2023, the health event that popped up in January 2024 wasn't applicable. So she would have been likely covered for it, having the full benefit, and now she'd be getting a full benefit of that 70% of the 140. So as I mentioned earlier, I didn't increase my policies for a 3-year period, and I probably got lucky. Obviously, you always get lucky if you're not making a claim, but I probably got lucky that I didn't, because I know my policies were far different than what they should have been when I updated them.
Awesome. Now we have the case of a client who did look to increase their insurance. So this client was 27-year-old, female, school teacher. She didn't have any debts at the time that she first came to us. We had recommended, amongst other things, TPD insurance of $660,000 based on various factors. And at that time, perhaps she felt that was a bit too much, or maybe she didn't want to pay that much for insurance. So she ended up going ahead with just the $300,000 of TPD, which she preferred. 3 years later, she had taken out a mortgage with her partner, and that mortgage was $642,000. So she came to us, she wanted to increase her TPD insurance to kind of cover that risk there. Unfortunately, when she went to do that, she was unable to increase it as her health had changed. So BMI changed, cholesterol levels, endometriosis, she had some bladder issues that were ongoing as well. There was a bit too much going on. And at that time, the insurer said that they wouldn't increase the TPD cover. Thankfully, her policy had future insurability in there. And because she had recently purchased a house, we were able to get a copy of those mortgage documents, supply those to the insurer, and ask that they increase it based on that future insurability benefit. So yes, it wasn't a huge increase. We weren't able to add, an additional $600,000 or whatever it is that she might have wanted. But we were able to get an additional $75,000 of TPD added to that policy. So, and that didn't require her to go through medical underwriting. So for all other purposes, she was technically deemed uninsurable, but she was still able to increase that. So that was a good outcome there.
Awesome. So how to start. So there's probably 2 things in terms of how to start from here is starting with reviewing your policies. In terms of if you are a client of Skye, reach out to any of our means via Skye, whether it's email, our website, and we'll book in a review call, go through what your policies are, what we originally recommended, what your situation looks like, and figure out what we're doing. Do we need to start from the start and provide you a new financial advice document? Are there just a few alterations you want to make and you know exactly what you want to do? Or is it just okay to have a phone call and go, perfect, I think I'm in the right situation than what I am at the moment? The other one is if you're not a Skye client at the moment, but you have another financial advisor elsewhere, reach out to those guys directly. If they helped you set up your policy, they should understand why they set it up the first time and be able to explain what your situation looks like now and how that's going to be affected by your policy. And the third one is if you don't have an insurance policy at the moment, getting in contact via Skye as well, or any other advisor out there, and figuring out, hey, what do you actually need, where to start, start that process up of making sure that you're covered, so that you, if something goes wrong, you're not Walter White. Awesome. So if you want to book a call, there is a QR code here, or there is a link there. There's also, if you go via our website, skye.com.au, you can book in via our website. So these are our 6 current advisors at the moment. We have a further 3 associate advisors that you may speak to. So yeah, if you do have any questions, feel free to reach out and we can help you out.
Perfect. So next we've got a Q&A. If you have any questions that you've thought of throughout this webinar, please place them in the chat now and we'll make sure we get to them. We've got one question already. So someone's asked, if I've had new health issues and I tell the insurer when I'm changing my cover, can they change my existing cover? So for example, could they apply an exclusion to all of my insurance, even the insurance I had before the health issue? So no, in that case, they can't alter the cover that you already have. They can only improve it, if they have a product change. They could potentially improve your cover, but they can't add exclusions to policies that you already have. So yeah, like in my case, wrist issue, back issue, if I increase that, potentially the new amount will have those exclusions, but the existing amount never will, because I didn't have those issues when I took out those policies. Now, in saying that, that's the case for retail insurance. Trent, do you want to speak as to how that might change if you're looking to increase your cover through your super fund?
Yeah, group cover is sometimes the case that they could backdate that policies. They certainly used to, where they wouldn't have part with exclusions and part without exclusions. I've seen recently, though, that has changed a fair bit. So usually what they're able to do, or what those super fund policies usually do, is they give you a level of cover. Let's call it, they usually call it units, but it's usually between $50,000 and $150,000. If you went directly to your super fund and said, I want to take out $1 million of cover, what often is the case is they'll still give you that $150,000 without the exclusions. So they usually might call it 3 units without exclusions. And then they might add an extra 15 units on, which gets you to that $1 million with the exclusion you're expecting. So it has changed a fair bit from what it probably was about 5-10 years ago, where they would just go, well, if we're applying exclusion, we're applying it to all of it. But yeah, that's again a case-by-case basis. It's something you should look out for on your current super policies, and ask those questions directly to the insurance companies as well.
Yeah, perfect. Alrighty, we've got another question, Trent, from Ernie. So he said, if your partner is on maternity leave for a year, would it warrant having to change your policies? So that's a really good question. With anything, if you're ever unsure, just reach out to your advisor and have a chat. Things don't necessarily have to change. So if your partner has income protection and they're not planning on being on maternity leave for longer than a year, then it's likely that they might actually still be covered while they're on maternity leave for income protection. But yeah, if you're unsure at all, or if potentially, money's feeling a little bit tighter, maybe you want to adjust some things, 100% reach out to your advisor, have a chat, get an update on, what your situation is and what your options might be from there.
Yeah, this is probably the biggest question for what does your current policy look like? So there are, especially if you're looking at income protection being, well, if you're on maternity leave and you're earning or your earnings drop to the government maternity leave, or you might have a special employer maternity leave, your income's going to be a lot less typically, and you're not going to be working. So if you have some income protection policies, they'll look back to 3 years of your last 3 years of working and go, how much have you earned over that last 3 years, and potentially find a 12-month period in there. A lot of the new income protection policies or the group policies will only look at the last 12 months, but most of our insurance companies, and again, it might change, and this is why we need to look at your direct policies, they might offer that extra 12 months. So if you're on maternity leave for 12 months, they might go, well, that's maternity leave, so we're happy to look back the previous 12 months and go, well, you actually earned money in that year before, so we're willing to pay you out, even though you're physically not working, but you become unable to work because of a health incident and those sort of things whilst you're on maternity leave. That does apply to paternity leave as well, Taryn. 2024, paternity leave is just as important as maternity leave. So yeah, paternity leave works well.
Awesome. We've got another question here from Jasper. So this is a great question. Is there a way to know before applying to increase cover if the new cover would be declined or if I'm going to have any exclusions? So really good point there. What we will often do as advisors, we'll often do what's called a pre-assessment. So we will get a bit of an update on your health situation or your work situation or whatever it is. we might look to de-identify that information and have a chat to a number of insurers and say, hey, this is our client, this is their situation. If they were to apply for cover or more cover with your company, what would that look like? Would you look to apply an exclusion? Would you charge a loading, so a higher premium? Is there no chance of this application for increased cover being approved? That can help us get a sense of what's available on the market. Potentially that might not always be the case. If you know your health hasn't really changed at all, nothing's happened, you've not had any particular doctor appointments over the last year or so, maybe you wouldn't need to go through that process. So probably more of a case-by-case thing.
Awesome. Do we have any more questions coming through? It doesn't seem so at the moment. I'll just answer this one live, which we did. I didn't bring it up. Give it a couple. You go, sorry.
Yeah, I might even mention with that last question, getting to know if you're going to have any exclusions or loadings, that becomes difficult when you're increasing cover, group cover, so cover through your super fund. Generally, they won't give you the option to pre-assess. You just need to actually lodge the application and kind of hope for the best from there. So again, another advantage of speaking to a professional, a financial advisor who looks at insurance, they usually will have those relationships with the insurers where they can have a chat beforehand.
I can answer that one. So we've got a question here from Rihanna. What info do insurers need to increase your cover due to salary increase? And does this work if you're working overseas and in a different currency? So there's a few, that's probably a double question. I'll answer the first one. What info do insurers need to increase your cover due to salary increase? That part there is typically straightforward. In terms of if you're using these guaranteed future insurability options, they may ask for a contract or an updated contract that says, hey, you've got a pay jump, because they want to look at this time frame to increase it. But without, if you're going through regular underwriting, typically they don't actually even ask for it, because what they look to do is they'll just ask you the questions. They don't need it in writing or anything like that. But the reason for that is at claim time, what they're going to do is look at what you've earned over the last 12 months or the last 3 years. So if you are not telling the truth, at claim time, you then need to prove what you're earning. So it doesn't really make sense to be covered for more than what you're actually earning. So usually they don't need too much information. That changes when you're self-employed. Self-employed becomes a bit more difficult because they want to know your ins and outs of the business, not just what you're taking home, because the business is losing money, but you're taking an income from it. Are you actually earning that income? So there's a bit more nuance in that. The last question is probably even more difficult. If you're working overseas, the short answer is they don't typically look at increasing your cover. That may change in the future. Reach out to Skye. We'll be able to talk to you in regarding that if you are overseas, because we may have a few options for that moving forward. But yeah, the typical answer for most insurers is you need to be in Australia. That may change in the near future. Hope I was able to answer your question there without talking around it too much.
Awesome. We've got another question about parental leave. So this question asks, do you have to be fully on leave for the extra 12-month leeway for income protection on parental leave? Or could it also apply if you're on reduced hours, returning to work slowly over the first 12 months of parenting? Does that make sense? I have baby brain. Love it. So I guess it's a case-by-case basis. I guess my understanding of the question here is maybe you have gone back to work part-time. I think that might be Trent. Would you agree that's what the question is there? Yeah. Yeah.
So you're working a little bit part-time there on reduced hours. So there are a couple of things that they'll weigh into. If you're in, and this is generally speaking again, some of the insurance companies will go, well, you are earning a little bit more in the previous 12 months. So if your income, usually I think the calculation they use is if your income has changed more than 25% in the last 12 months, they could potentially look at maybe an average of the last 24 months or the previous 12 months again. That's relatively nuanced across different insurance companies. You're probably less likely to get that feature in, say, a super fund. But a retail policy, you may be able to get that. So yeah, again, it's all nuanced and best to speak to an advisor or looking at the PDS for your policy. There might be different features regarding sabbatical leave and maternity leave that you might be able to go and extend that to going, well, I'm only working part-time and they extend it, or my income's dropped by more than 25%. So they give you that extra little period of time as well.
Yeah, and that's a good point Trent made as well. If you are unsure about the specific features of your policy, it should be outlined in the PDS, so the product disclosure statement that you would have been given when you first took out the cover. So you can either refer to that for a bit more information on how your policy works. If you do have an advisor, lean on them, reach out and ask the question. They can look into that for you.
Awesome. Any final questions? Sounds good, Taryn. Book. I'll bring the link back up for you. If you book in, you'll book in with someone. We'll figure it out. We'll be able to help you out. Any final questions? Here we go. Zara, do you want to take this one on?
Yeah, sure. So the question is retail cover typically more expensive than group insurance? So retail cover, the cover that you get usually through an advisor with an insurance company, group cover being cover that you get through your super fund, for example. So the common misconception is that super fund insurance is heaps cheaper because people have some super fund insurance and they barely pay anything for it. What people don't realize is you're barely paying anything most of the time because you've barely got any insurance. What we've actually found in our experience, and we've looked at hundreds of cases where we've been replacing someone's group cover, and the new insurance, the retail insurance, when we compare it on a like-for-like basis, so the same amount of covers, similar-ish features, same premium structure, I'd say more times than not, the retail cover ends up being cheaper. So generally you've got better quality cover, you might actually be paying less for that overall than what you would if you increased your cover through your super fund. Of course, that's all on a case-by-case basis. It's not going to be true every single time, but it is a surprising outcome that we see over and over again with our clients.
Yeah, I'm just asking our team to chuck in. So we did a webinar on this maybe a month ago, maybe a little less, maybe a couple of months ago even, on this exact topic. I'm asking the team to put it in the chat, but if not, we might be able to send it out when we send out the link for this one. So if you are interested in seeing what that looks like in terms of a project, that works as well. So what we did is we did our last 500 clients at the time. What would it be if you took out all the cover we're looking to recommend with their chosen super funds versus the insurance company we look to use? And some of the data was pretty alarming in terms of how much more expensive it would have been if you took it out with a super fund, which is, relatively common misconception.
Yeah, and it's not even in those cases that we looked at, it's not even that we were comparing the super fund insurance with the cheapest insurer available. Often they weren't the cheapest insurer. Often we were recommending that insurer because they offered a more generous medical assessment and they were more expensive than other insurers, but often still cheaper than the super fund insurance. So very interesting.
Awesome. So the next question is regarding where is Skye located? Can I have a meeting with someone in person? I'm in WA, or is it contact via phone and email only? So Zara is actually in Brisbane. I'm in Melbourne. We do have an office in Melbourne. Not many people go to it though. And everything we do in terms of Skye is online, unfortunately. So we're probably not the best people to work with if you need, or if you really want to work with someone in person. Our advice meetings we typically do on a Zoom meeting, so we're able to go through all the concepts we're looking to do. You can see us, make sure we're real people, and help you out doing that. But unfortunately, we don't do pens and paper, and we don't do in-person meetings, unfortunately, at this point.
Yeah, and we try to make it as easy as possible. Like, for example, if you do choose to go ahead with getting advice through us, we have an online form where you can digitally upload your super statements and fill it all out on your phone or in your computer. And then, as Trent says, no pens or paper in our business. So forms are digital, a lot of communication via email and things like that as well. So, and phone calls, of course. So we try to make it as seamless as possible. I'd say in my experience, having worked in a place where everything's done in person, I think this is even easier.
Awesome. Here we go. So Skye, I ran the last webinar. Skye actually won a prize that we ran, and I was confused whether it was a Skye client or one of our Skye admin. But this is a bit of a testimonial here from Skye. She'll read out. I've just gone through the process with Skye Wealth, and I couldn't believe how much I saved and increased my insurance, included trauma for myself and my children, etc. I'm not with my super fund, but I can still pay with my through my super and get a better deal, but can still top it up. Definitely worth going through Skye for sure. And no, I don't work for them. My name is coincidentally Skye. What it cost us to sort it out, we saved right away. Thanks, team.
Thanks, Skye. Skye, I hope you got your prize from the last webinar.
It did take me a bit longer to send it out than I'd like, because the second person that won the prize didn't actually reply to me, and it's still sitting here. We couldn't figure out what we were going to give away the prize for tonight. So I don't know what we're going to do with it now that I've shown it, but I might find someone to send it to. I might go through the list and find someone to see if they want the prize or not.
Love it.
Awesome. That might close us off. We've got a couple more slides to go through. So did you love this webinar? We're having another one again next month, so August the 20th. You can sign up here to find out more about it. We're talking about unlocking your dreams, achieving home ownership with confidence through personal insurance and home loans. So we have, who's running that one? It looks like Phil and Rochelle is running that one from Sphere Home Loans. So yeah, we're talking mortgages, insurances, and everything you need to know within that as well. So it should be great. And would love to hear feedback. We love hearing about our improvements, what we did well, what we did poorly, and how we can make this better for everyone in the future. So please, you will get a link after you finish this finishes. So it might take you a minute or two. Any feedback is great, good, bad, or otherwise. So that would be great. Rihanna asked if there's another branch of Skye. So we work with multiple referral partners. Sphere is one of those that works with home loans. So if there is any other financial service, I guess you want to call it, that you want to look at, whether that's full service financial advice regarding investments, retirement, home loans, those sort of stuff, feel free to reach out to us. We work with a lot of different practices, and we can help you, point you in the right direction, whether that's state-based, your needs, whatever that is, home buyer's agents, those sort of things. So if you ever need anyone in any financial service, reach out and we can point you in the direction for, or at least give you a couple of options.
Yeah.
Awesome. Thanks very much. Hope you all have a good night. And thanks again for attending.
Thanks, guys.